Problem 2, partnership operations. So Brilliant Berry LLC, a cash method calendar year LLC, is a brick and mortar bookstore that specializes in cookbooks for berry-based desserts. Strawberry and Raspberry calendar year individuals are both equal member owners of the LLC. They formed the LLC several years ago by both contributing cash. There's no other contributions that have been made to the LLC. The LLC had the following income and expenses for the past calendar year. So you're given a list of items: gross income, general business expenses, depreciation on machinery, charitable gifts, Section 1231 gain, that part of it was recharacterized as Section 1245 ordinary income, short-term capital gain on stock sale, interest on tax-exempt bonds, dividends on stock, gain on the sale of land held for 4 years by the LLC for investment purposes. And you're asked 3 major questions. There's some subparts on those. The first question we're going to address: how will the LLC and the owners report these items? So let's go ahead and look at that question first, because each of these are separate. You need to do these questions in order, but let's start there. Okay. So it's important to remember that the partnership, well, here it's an LLC, right? Multi-member LLC. We're not told otherwise. So the multi-member LLC, of course, is going to be taxed as a partnership. Partnerships file Form 1065. Now, if you've never seen a Form 1065 before, just stop the video and pause it and go look at Form 1065 on the IRS website. If you look at Form 1065, on page 1, we've got the main ordinary business income area, income loss area. Okay. If you look at Schedule K, so that's page 1. That's where we find the main ordinary business income. Let's combine 2 things there. Income loss. Right? You'll have your gross income minus certain deductions. That gives you your ordinary business income loss. Schedule K, which is later on in the 1065, you also are going to find that ordinary business income loss is going to flow onto Schedule K on line 1. And then you're going to have a bunch of other lines for separately stated items. Now, when it comes to the partners, the members here, they get a Schedule K1. And the Schedule K1 that each member gets, right, Raspberry and Strawberry, that's going to mirror the Schedule K from the Form 1065. Of course, they're going to have their ownership or their percentage allocated distributed share for those. Here, they're both equal members, and we're not told anything specific about allocation, so we're just going to assume that it's just going to be a 50-50, straight down the middle, everything. Everything's 50-50. There's no special allocations here, which we're going to talk about in later topics, allocation topics. There's no liabilities here to worry about, no special liability allocations. Everything is just 50-50. So whatever that Schedule K has for the Form 1065 for the partnership, right, Brilliant Berry LLC, that's just going to be split between the 2 from that Schedule K onto the K1. Boom, just like that, okay? All right, so what we need to do is we need to go through these lists of items. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9 items here. We need to go through these 9 line items, and we need to classify either all or part of the amounts as either one of 3 things. Ordinary business income loss, we also call this 702A8. And again, that goes under page 1 of the Form 1065 and also on line 1 of the Schedule K. So that's the first classification. We also need to classify any separately stated items, which, remember, those items are items that any hypothetical partner could have differences, whether it's for limitation purposes or different types of taxpayers. And the third is we look at non-taxable So non-includable or non-deductible items. Okay? So what I'm going to do is I'm going to erase that information there. Yeah, keep that in mind. Write that down. Stop the video if you need to. Take note of what's on the right there, because I'm going to need to give us some space, because we're going to need to, on the right side of our little chart here, we're going to need to make some space to classify these items. So I'm going to go ahead and erase. That just gives us an overview of what we're doing. And again, if you have yet to look at that Form 1065, please go ahead and do so along with the Schedule K1. Okay, so we're going to set up our little chart. I do a little chart here for this one. So the first line, we're just going to call this the 702A8 bottom line number. Okay, I just label it as 702A8. Okay, that's going to be our first one. Then we're going to have our separately stated. I'm just going to abbreviate that SS, separately stated. And then finally, we're going to have our non-taxable. Non-taxable are going to be both non-includable in income, if they're income items, and non-deductible if they're outflows, expense items, or deduction items. Okay? So what you're doing is you're going through all 9 items independently, and you're trying to determine, hey, is this something that would make no difference regardless any kind of potential taxpayer out there? And you're asking. And remember, the general rule is that for income, if it's ordinary income, it's almost always going to be 702A8 bottom line, ordinary income, ordinary loss. So again, income and losses or income and deductions go into this area, but for income, it's a lot easier. Deductions are almost always separately stated because of the limitations. As you know in the tax law, there's a lot more limitations on deductions than there are income, right? Remember the Supreme Court case? Incomes construed broadly, deductions narrowly. So there's a lot more limitations on deductions out there and credits and those kinds of things. The first one, gross income from business operations, $130. So that is going to be an ordinary income loss item, ordinary business income loss item, bottom line, section 702A8. So we're going to put it here, and I'm actually going to keep track of the numbers. We're going to do a 130. 130. Okay? Okay, the second one, general business expenses deductible under section 162A. If you don't know what section 162A says, you probably need to go back and watch my previous videos or just go look at section 162. It's the catch-all for business deductions. It says that a deduction is allowed in a business setting if it's ordinary, necessary expense paid or incurred during the taxable year in carrying on any trade or business. Not investment activity, not personal, business activity. But it has to meet all those criteria: ordinary, necessary, expense rather than capital expenditure, paid or incurred during the taxable year in carrying on any trade or business. It has to meet all those. And all those have been litigated in the courts. All those different terms, conditions. So it's basically saying, hey, it meets all that. You might think of this like, okay, compensation, paying your employees. That's a pretty good example of that. You got to pay employees, right? That's ordinary, necessary. It's an expense. It relates to the current tax year. It's been paid this year. It applies to this tax year. That's a perfect example. If you want to think of that here, use that example. Compensation. Advertising. That's another one that's really plain vanilla. You got to pay it, right? So general business expense, that's also going to be a 702A8 number minus 40, okay? And the idea there, you got to think about each of these items. Would it make a difference? Any hypothetical possible taxpayer, and even within a taxpayer, could it make a difference? Well, ordinary business income is going to be reported as income. There's no way around that for any type of taxpayer. Maybe if you have, tax-exempt partners and stuff like, or tax-exempt owners, but I will tell you, don't go down that path. When it comes to differences in tax rates, right? A tax-exempt owner is a zero, or tax-exempt entity is a 0% taxpayer. We don't care about differences in tax rates, right? C corporation has a different tax rate than individuals. Tax-exempt is at 0%. We don't worry about that difference. We worry about things like limitations, how corporations get special deductions, like the dividend receipt deduction. We worry about things like that. Or how it can make a difference for a respective person. Normal business income is going to be normal business income for any kind of taxpayer. It's going to be reported. There's no limitation on that. General business deduction is going to offset general business income, regardless what kind of taxpayer. That's always the case. Okay, the next one is depreciation on machinery. Calculated under the 200% declining balance method, and it's $30. $30 of obviously an expense. This is going to seem a little weird because in my videos I always go in order. We're going to come back to this one. Let's just put a little question mark on this one, put a pin, whatever you want to call it. I don't care. We're going to come back to this one because this one's the most difficult of all of them, which gives you a hint it's probably not bottom line. It's not. I'll explain why later, but it'll make more sense as we get down to the end. Okay, number 4, charitable gifts. This one's pretty easy to understand, but there is one exception that makes it a little bit more challenging. So again, the question is, if there are any limitations out there to any kind of taxpayer, differences in taxpayers, differences with anything specific to the owner with respect to maybe other ownership and other entities and flowing, right? Maybe you've got charitable gifts from 20 different LLCs, and maybe you're limited to your AGI, and you don't know if it can be deductible until you look at all of them together. So the answer is that charitable gifts are going to be considered separately stated, because think about individuals, and this is the way I always think about these. If an individual owned a bunch of LLCs and each LLC reported charitable gifts, at some point it might be limited, but you don't know that until you take those separately stated amounts and you put them together. That's why it has to be separately stated. It can't offset the 702A8, because 702A8 gets reported net on the partnership tax return. And if you don't separate it out, you can't limit it. So that's one reason why it's separately stated. The other reason, this one's a little bit easier to understand, you might know that individuals have certain AGI limits when it comes to charitable contributions. Corporations don't have AGI, but they have a taxable income limit. So differences in different types of hypothetical owners, like a corporation partner or member for LLC versus an individual, that also creates separately stated. Some of you might be wondering, well, hey, we've got Raspberry and Strawberry. They're both calendar year individuals. So why would that ever be an issue? In the tax law, we don't worry about who the actual owners are. We say any hypothetical. So even if there's individual owners, we still just focus on the fact that there could be differences in different owners. If there's any hypothetical possibility of difference, even if it doesn't apply to your respective partnership. Because it would be too difficult to administer if we had to apply it differently. Because the way the K1 is set up is that, hey, charitable gifts are always going to be separately stated. Okay? So I think I made it pretty clear why it's separately stated. But here is the difficult part of the question, or difficult part of charitable gifts. Section 703 A2C specifically says that with respect to the partnership, charitable gifts are non-deductible. So you're wondering, you're saying, oh, what does that mean? That means that with respect to the owners, right, Strawberry and Raspberry, they're going to be able to get benefit from this, as long as it doesn't expire after the 5 years, whatever the charitable gift carryover rules are. But for the partnership, they're not able to offset. That's all it means. So and ultimately there is benefit. So what you're seeing is that we're putting both of these, or putting the $20 charitable amount in both. I'm putting it in both. Let me put some lines here, by the way. Make it a little easier. Okay, so that one's confusing, I know. But again, ultimately, just think of it like this. Strawberry and Raspberry, it's going to flow out to them. It's just making sure, 703 is just making sure the partnership does not get any benefit from the charitable contribution. That's all it's doing. Okay? It's reported separately stated and as non-taxable items. All right, number 5. Number 5 is a fun one. Number 5, we got a gain on the sale of equipment used in the LLC business. $20 of that is ordinary under Section 1245. And 10 of it is 1231 gain. After we've gone through the charitable contributions and I've kind of made clear what a separately stated item is, it's pretty clear to see that a 1231 gain is going to be a separately stated item, because 1231 gains and losses, as you know, get netted by the respective taxpayer, and what the net result is affects what the ultimate tax consequences are. Long-term capital gain, long-term capital loss, or ordinary gain, ordinary loss. So that means that we need to separately state it. Okay? This is what's going on in number 5 if you're confused. There is a $30 total gain. And under the tax rules, it was characterized as 1231. However, as you know, 1245 trumps 1231, and $20 of that 30, probably because depreciation was taken. So $20 of depreciation would have been taken most likely on this equipment. $20 of that is 1245 ordinary income. And 10 of it continues to be 1231. So the portion that's 1231 is considered separately stated. So I'm going to put a 10 here, 1231. And then the $20 of 1245 ordinary income, that's going to be treated similar to number 1, gross income from business operations. It's ordinary income. Remember, the general rule is if it's ordinary income, it's very rare to be separately stated. It's almost always classified as ordinary business income under 702A8 and gets lumped together. So we get to put 20 there. And we're not even going to say what it is because, again, everything in this category gets lumped together. It gets lumped. That's what 702A8 is. It's a number that gets lumped together. Yes, it gets shown on page 1, like, okay, yeah, there's income, there's expenses, there's that. But that number on the K1 for the owners all gets lumped together. It's only one line, one number on a K1. And the idea is separately stated. You need those separately to add together because you can't just lump together an ordinary item if 1231 goes into that. It wouldn't work for calculation purposes of other items. Okay, the next one. Next one's easy. Any capital gains or losses, always going to be separately stated because, as you know, capital gains, capital losses have limitations and different rules for different owners, like corporations versus individuals. So number 6, easy. It's going to be $10 of separately stated because it's a short-term capital gain. And it will go on the box for short-term capital gains, just like the 1231 will go on the box for 1231s on the K1. Okay, number 7. Interest on tax-exempt bonds. So under Section 103 of the Internal Revenue Code, municipal bond interest, state and local bond interest that qualifies is excluded from gross income. This is obviously going to be non-taxable. Now, you might be wondering, well, why does it get reported, right? If you're an individual, or certain types of taxpayers, individuals, yeah, you do report tax exempt on your Form 11 or Form 1040. It's just not reported as gross income. But it's still listed out if you look. Most taxpayers, though, they don't actually show their tax exempt interest. It just gets excluded. The reason why you need this is because it goes into your basis calculation. If you don't increase your basis by the 40, guess what happens? You get double taxed. Or you get taxed on what you shouldn't be taxed on. Is really more like it. So that's number 7, interest on tax-exempt bonds. Number 8, dividends on stock. Let me explain this one. So first thing, at the time of this video, and this might change in the future, certain dividends get preferential tax treatment, right? Qualified dividends get preferential tax treatment. But that wasn't always the case. At one time, we didn't have that. Okay? We didn't have that at one point. All dividend income was taxed at ordinary tax rates for individuals. However, even when that was the case, dividends were still separately stated. You're like, okay, well, ordinary income. The ordinary income is always reported bottom line. I said almost always. When it comes to portfolio activity, interest is separately stated as well because, as you know, investment interest expense, you're allowed to take a deduction up to the amount of investment interest income. Similar rule for dividends when it comes to dividend income with respect to that activity. Another reason why dividends have always been separately stated is because corporate taxpayers get the dividend receipt deduction. Yes, we don't have a corporate taxpayer here, but again, it's any hypothetical possibility. So corporations need to know the dividend receipt deduction so they can report that on their 1120, so they need to break that out. So dividends are always going to be on stock, or always received by the partnership, LLC here, always going to be separately stated. So we got $20 of dividend. By the way, at $10 short-term capital gain on stock sale, listed that out there. All right, number 9 is the last item. Then we got to go back to depreciation. Number 9, gain on the sale of land held for 4 years by the LLC for investment purposes. If land is held as an investment, it's going to be treated as a capital asset. If it's sold, it's a capital gain. So a sale of a capital asset results in capital gain under section 1221, 1222. It's been held for 4 years. What does that mean? Long-term, exactly. Long-term capital gain. Capital gains, whether they're short-term or long-term, guess what? They get separately stated. So we got $100 long-term capital gain. This is dividend. It's a short-term capital gain. If I said short-term capital loss earlier, my apologies. It's short-term capital gain for number 6. It's important to remember that any gains and losses, make sure you put the correct direction that they're going here. So let's just review, and then we'll go back to the depreciation. So number 1, gross income, that from business operations, that's always bottom line. General business expenses, that's going to be bottom line as well, but of course it's an outflow. 3 we'll come back to, it's depreciation, calculated on a 200% decline balance. 4, charitable gifts, that's an outflow. I have it under both, non-taxable to partnership, right, non-deductible by the partnership, and then separately stated. Number 5 is a gain, so all of its gain. 20 of that's 1245 and 10 is 1231. Number 6 is a short-term capital gain on stock sale of $10. Number 7 is tax-exempt interest. Number 8, $40. Number 8 is dividend on stock, so I listed that, $20. And finally, number 9 is $100 long-term capital gain. Okay, so we've done everything properly. Let's go to number 3. That's the last one, depreciation on machinery. Calculated under the 200% declining balance method. So this is the most difficult. After we've gone through numbers 1, 2, 4 through 9, it's still difficult, but at least you got a better idea of what we're doing. We're asking, is there any possible way that this information, that this depreciation needs to be separately stated? We need to keep the $30 expense amount. We cannot lump it together because as it stands right now, you see that 702A8 column, the 130 minus the 40 plus the 20. As it stands right now, we're going to have 110. Strawberry and raspberry are going to report 55 and 55 on line 1 of their K1. Guess what? That 55 and 55 does not specifically say whether it's gross income for business or general business expense or 1245 ordinary income. It doesn't say. It just says $55. We don't know what it is. It could infinitely be anything. It could be $1 billion of income in this amount, and it could be $1 billion expense, and it results in a $55 net amount. So do you see the issue? The issue is that whatever is listed on line 1, the 702A8 bottom line ordinary income, ordinary loss on the K1 to the owners, because remember the entity and aggregate theory of partnership tax. This is the pure aggregate theory. It gets reported to the owners, and then that then flows on to their 1040 for individuals here, and then guess what happens? It gets reported as it is, the character, whatever it is. So that's just going to go on to ordinary income or ordinary loss. Get reported on the 1040. We don't know what it is, and that's why separately stated, it makes a difference. Because you say, hey, I have $10 of 1231 gain. Maybe I have another 1231 loss from another LLC of $40, and then that offsets to a net of negative 30, and then hey, that $10 from the 1231 gain from Brilliant Berry, that gets treated as ordinary, even though if the LLC treated it, it'd be treated as capital. So it makes a difference. But you need to know the amount because obviously the netting makes a difference. You can't lump them together for anything. Because if it was lumped with the 55, you wouldn't know what it is. So that's the issue, to show you. But we still have to do number 3. Depreciation on machinery. Calculated under 200% decline balance. Is there any reason why It needs to be separately stated and it cannot be lumped together. Depreciation, the general rule is that depreciation creates an ordinary deduction. So you're thinking 702A8. That's what you're thinking, right? But is there any possible way that a taxpayer, hypothetically, would need to know that number? So the reason why it's separately stated and why it might be needed separately to be kept $30 of depreciation calculated on a 200% decline balance is because if you have a corporate partner and they're trying to determine their earnings and profits, we start off with taxable income of the corporation. We then adjust the taxable income of the corporation by all adjustments, we call them, under Section 312 for earnings and profits calculation. And earnings and profits is kind of like retained earnings for financial accounting purposes. And for financial accounting, you mostly do straight line. 200% decline balance is not what you're probably doing. So for that purpose, there's a difference between taxable income and earnings and profits, and that $30 of depreciation would be needed for that adjustment. So just because it doesn't affect maybe a characterization or whatnot, it does affect earnings and profits for the corporation. So it needs to be separately stated, even though there isn't a corporate taxpayer here. We still do it because, again, it'd be too hard to administer if we do it separately for each type of taxpayer or each type of partnership with respect to the facts and circumstances. So that'd be $30 of depreciation. If you go to Section 702, you'll find a list of many of the separately stated items, but not all of them. Same with the regulations. Okay? All right. So we've finished everything. So what you can do now, we can zoom into our chart here, okay? Anything that's separately stated, right now what I would do is I'd pause your video, go look at a 1065K1, the Form 1065K1. You will find lines for all these respective items. If you go through the K1, you'll find lines for each of these items. You'll find a line for Section 1231 for short-term capital gains, for long-term capital gains, for dividends, for interest, all these different things. For charitable contributions, you'll find all these different things. Put a CC for charitable contributions. If you don't find a line for something, you'll see there's other income, other deductions. Also on the K1, you will find these non-taxable items, right? We had the $20 of charitable contributions. We had the $40 of tax-exempt interest. You will find lines and codes that relate to these as well. So these all get separately stated. When it comes to the 702A8 bottom line, this is going to be line 1 of the K1. And it will respectively be the percentage that with respect to each owner. So the question is asking how the partnership, the LLC actually, right, Brilliant Berry LLC, how it reports this stuff. So on schedule, on Form 1065, on page 1, it's going to have 110 of ordinary business income loss, okay, of 110. That's this number here. And then it's going to have, on Schedule K, it's later on in the Form 1065, it's going to have all these broken out, these separately stated non-taxable items. It's also on line 1 going to have the $110, okay? For the owners, they each are going to get a K1. Raspberry and Strawberry both get a K1. Remember, it's 50-50. They're 50-50 owners. Everything is going to be split 50-50. So on line 1, Strawberry reports 55, Raspberry reports 55 of ordinary business income loss. With respect to each of these separately stated non-taxable items, you take each one and you take half and half. So for example, the long-term capital gain, the item 9, Strawberry is going to have 50 of that as long-term capital gain, and Raspberry is going to have 50 of that long-term capital gain. So you actually break it up based on their ownership percentage in this problem. Now, it's not always based on ownership percentage when you do allocable shares, distributive share. It gets a lot more messy than that, and I have other videos that go into allocation in terms of how you allocate things. Some things might be allocated to one owner, like depreciation. We'll see issues of that later on. Okay, so we are done with the first part of the problem. The next part of the question says, how or would the treatment of the last item be different if Strawberry were a dealer in real estate? So for this one, this is more conceptual. I'm going to kind of just talk about this and how it works. If you remember from my previous videos and previous discussion, you might recall that when the partnership receives an item from a partner, it's how the partnership holds the property that matters, not how the partner held the property. So if Strawberry were a dealer in real estate, and Strawberry and the partnership has this gain on the sale of land, well, land in Strawberry's hands, land would be inventory, which would be ordinary income, right? And that would be different than long-term capital gain. However, we're focusing on how it's held as the partnership, not Strawberry. That's completely fine. So the answer is, would it be different if Strawberry were a dealer? And the answer is no. We focus on the partnership. We focus on the partnership. Under Section 702, it seems ambiguous, but through the tax law, it's actually, we focus on the partnership. Now, what if the LLC acquired the land from Strawberry, who's a dealer in real estate, as a contribution to the LLC for the ownership interest? Well, that would be the inventory rule of Section 724. Remember the 5 years? So you have to hold, within 5 years, if it's sold, it keeps that same character as ordinary, right? So then that make a difference, right? The idea here is, what if Strawberry contributed this land, item 9, the one they get $100 gain on, right? It's within 5 years. They've held it for 4 years. Partnership sells it after 4 years. Okay? Now it would be ordinary income. It would be ordinary income to the partnership because it's within that 5 years, and it would make a difference. Okay, let's go on to the next question. The next question focuses on adjusted basis. So we talked a lot about adjusted basis of partnership interest and also to the property when we talked about formation and those problems. But now we're going to focus on the adjusted basis of Strawberry. Just taking Strawberry as an example, obviously Raspberry has a basis too. Okay, because on the K1 it also reports the basis of partnership or partner going forward. So we're told in the problem that Strawberry's beginning basis at the beginning of the year, this partnership's been operating for a few years now. The beginning adjusted basis of Strawberry is 20. Okay? What would her basis be at the end of the year if the LLC made no distributions to the members during the year? That's obviously important. So the general rule is that at the end of the year, we adjust the basis. Okay? We increase for income and gain allocable to that owner. We increase also for any contributions during the year, including changes in liabilities. So we saw a problem earlier when we dealt with formation with liabilities. If the liability percentages change, maybe like ownership changes and liability therefore changes, share of liability, that also could change the basis. We don't have any liabilities here. Just keep that in mind. We then subtract away any deductions or losses. As a general rule, we always do the distributions last. Distributions reduce the adjusted basis. If they exceed the basis, we're going to learn later in distribution videos that would be treated as a capital gain unless there's ordinary income or hot asset issues, and then it's considered ordinary character of part of that gain. But general rule is it'd be capital gain beyond the basis. Okay, so here we start with 20. We've got all these items. All these items go into affecting the basis. We've got income and gains. We've got deductions and losses. And we don't have any distributions for purposes of this respective part of the problem. Later we will. We're going to change it and say, what if there's a $40 distribution on March 1st to each owner? Okay. I'm going to make this as easy as possible. This is a pretty simple question, or pretty simple setup of a problem. It could be a lot more difficult when it comes to liability or basis with liability changes and contributions and lots of crazy things going on. Disguised sales, crazy things. Basis does not discriminate. So yeah, on the screen here, we've got ordinary items, right? We've got long-term capital, short-term, we've got 1245, we've got 1231, we've got all this stuff. All that matters for tax purposes, if something is an inflow, it's going to increase the basis to that partner or owner. If something is a outflow, it's going to decrease the basis to that partner. Also important to note is that the income and gains and deductions and losses, we also are going to include in that non-taxable income. So tax exempt. And we're also going to include in the subtraction for deductions and losses the non-deductible items. Because if you didn't do this, you'd either get a tax burden or benefit from the item. Okay. So what I'm saying is, to make this simple, we are just going to take all these items and then lump them up. We're going to add them together, and we're going to take half of it. Because remember, the two owners, strawberry and raspberry, are 50-50. So the bottom line equals 110. We got that, right? If you look at the separately stated items, 30 minus 20, that's what? 10 plus 10 plus 10, 30 plus 20 plus 100. Make sure I didn't see any outflows there. Oh, depreciation is an outflow. My apologies. See, I almost got myself there. So we got 30 plus 20. That's negative 50. 10 plus 40. So what was that, 90? 90 from the separately stated. And then we've already taken into account the non-taxable charitable. You don't double count for purposes of basis. Partner, member, whatever, only gets one bite at the apple. You only get to put in this separately stated for the charitable contribution once. Actually, it's to tax the partner's benefit. So separately stated is 90. If we add all the separately added and subtracted all separately stated items there, and then the non-taxable, we don't do the charitable contribution because we already took that into account in the separately stated. So it's non-taxable. We increase for 40. So these are all positives, right? If it was negative, you obviously subtract. So add, we're going to get 240. So we do 120 of that goes to strawberry, and 120 of that goes to raspberry. This is pretty easy. This number all summed together equals 120. There's no distributions in the first problem. Look at that. We got 140. So the adjusted basis at the end of the year, if there's no distributions, equals 140. Strawberry's basis is 140. So the next question asks us, what if on March 1st, the LLC distributes $40 to each member? So we start the year with a $20 basis, okay? Well, by the way, the basis rule, you find that in Section 705. All these are found in Section 705, the basis rules. That's where we find these increases and decreases. 705, the basis going forward, 705. We've already talked about we did 701 through 703 here. 704 deals with the allocation, the 50-50. 705 is the basis calculation. 706 is our partnership tax year and some other things. Those are 701 through 706. Okay. So now we're saying, what if we have a $40 distribution on March 1st? So this is a little confusing because if you think about it, we start the year of 20. We've got these income and deduction items, but we don't know when they occurred. So some of you might be thinking, okay, well, if a distribution takes place on March 1st, don't we have to know when the income and losses and all those things are attributable to so we can calculate the basis as of March 1st because those are increasing? And your general thought is correct. In the tax law, that's the general case. You look at the basis as that date. However, there's a special rule. The special rule says under Reg, and please make sure you note this, Reg 1.731-1A1, two little i's, This regulation allows the partnership to treat a mid-year distribution, so a distribution before the end of the year, as a draw against the current year's income. So the amount is not taxable even though it exceeds the partner's basis at the time of the distribution. By the way, this only applies to simple distributions like we have here, not complex distributions. The adjustments to the basis can then be made at year end, and a $40 distribution would reduce A's basis down to $100 under Section 733. So what I'm saying is, yes, March 1st is when the distribution takes place, but under this rule, under Reg 1.731-1A, two little i's, we can still do the 120 that happened during the entire year, this 120 that we allocated from the income and deductions from the activity, right? And we can do the distribution then after. And that will give us a $100 basis. It could make a difference, because if our basis was, let's say our basis at March 1st was $30, and we have a $40 distribution, we would have a $10 capital gain, a $0 basis, and our basis at the end of the year would be $110. But we'd have a $10 gain. You'd rather have no gain and a $100 basis than $10 of capital gain and 110 basis. Time value of money. So to conclude the problem, I mentioned that it is possible to have capital gain here if your distribution exceeds the amount in your basis. That rule is under Section 731. That's where I got the reg, by the way, for Section 1.731 because of that idea of distributions. So distributions, the important code sections here that apply are 731 and 733. And then there's a special reg that applies that allows the distribution to be taken from a draw from the income that was earned. So that really concludes the problem. It goes through all of these ideas, starting with how it's reported on the K1 and the Schedule K of the 1065, then drops down to all the way to the basis of Strawberry at the end of the year.